What's up everybody, Steve here. Let's talk about the real estate market. I'm going to go through a handful of articles. I'll leave the links below for you guys as well. There's certain wordage in some of these articles that make me very cautious about what's going on in the real estate world today. So this one is from Realtor Magazine. Again, I'll leave the links below and I'm going to read it off. Some very important lines that I think that we really need to pay attention to. So it starts with July home sales show recovery is sticking. Existing home sales soared 24.7% in July, outpacing the record growth of 20.7% in June. Existing home sales soared. So these are the common phrases that we heard in other real estate markets in the past, right before the inevitable happened. It goes on to say now 8.7% higher year after year, the strong rise in existing home sales. National Association of Realtors chief economist Lawrence Yun states, with the sizable shift in remote work, current homeowners are looking for larger homes, and this will lead to a secondary level of demand even into 2021. He goes on to say more homes need to be built. In Southwest Florida, understand something, real estate is micro, so this is going to be really dependent on what type of market you're in. And in Southwest Florida, and pretty much Florida in general, in most areas or many areas, we're in a very cyclical market, and there's been a huge boom in real estate construction in South Florida. The next article is from the National Association of Realtors as well. It states that properties are selling fast. Obviously, we just covered that. Fewer first-time home buyers are in the market. The share of first-time home buyers was 34%, down slightly from 35% in June. Investors are holding steady. It stated about all cash sales was about 16%, which remained unchanged from the month before. I think that there's been a lot of cash in the market because I think there's, based on a lot of other investors that I've been speaking with, a lot of people have been cashing out of the stock market and bringing their funds over into real estate. So they wanted a more tangible investment for themselves, which I think is further the reason why we have further cash investors coming into this market. And you have a lot of other investors that are coming from other states, especially to Florida, because we don't have any state income taxes. And also, distressed sales are down. Foreclosures and short sales represent less than 1% of total sales, falling from 3% in June. A lot of that has to do with the forbearances, which we're going to talk about here shortly. And at the end of the day, when things are down, as in distressed sales are down, it'll go up, and when real estate values are up, they will come down. All right, now this next article is from the Housing Wire. This is where things get a little dicey and sketchy in my professional opinion. 8.8% of U.S. mortgages are in forbearance. It states about 4.7 million mortgages are in forbearance, representing 8.8% of all home loans. The loans currently in forbearance total $1 trillion in unpaid principal. And it goes on to say Fannie Mae and Freddie Mac accounted for 7% of mortgages in forbearance, while loans backed by FHA and VA accounted for 12.4%. When a borrower is allowed not to make their mortgage payment, somebody is going to get stuck. And in this situation, it's the loan servicer. So figure a loan servicer kind of like a property manager, for example. So the property manager controls the property, they collect the rents, and then they take their portion of their cut, and then the rest of the money goes to the landlord. A servicer is basically the same, kind of an analogy for a property manager. They're kind of in the same position between the borrower and the bank. So they're the middleman. They take control of collecting the payments and then dispersing the money out to the investors, to the lenders, and so forth. So the servicer in this situation is stuck holding the bag. They don't have the revenue coming in, but they still have to disperse the revenue out to the investors. So in the Market Watch article here, it states that Fannie Mae and Freddie Mac will be allowed to purchase loans in forbearance. It goes on to say, we are focused on keeping the mortgage market working for current and future homeowners during these challenging times. Purchases of these previous ineligible loans will help provide liquidity to the mortgage markets and allow originators to keep lending. We'll jump into another great article, The Balance. The Balance goes on to say, on September 7, 2008, the U.S. Department of Treasury bailed out Fannie and Freddie. Congress authorizes purchase to purchase up to $100 billion in their preferred stock and mortgage-backed securities. Keeping the two afloat cost taxpayers $187 billion over time. Even in August of 2020, as a real estate broker in our local market, there are a ton of buyers. Inventory is low. A lot of buyers are coming into the market right now. They're trying to take advantage of the artificially low interest rates. And time will tell to see what happens after kind of the forbearance levels out. I appreciate you guys and your input, so let me know your thoughts below on this discussion at hand. Thanks a lot.